Hello students, on financial assets topic, this is my second video. In first video, I explained the meaning of financial assets and types of financial assets. There are total 10 types of financial assets. In first video, I explained first 4 types. In present video, I am going to explain the remaining types of financial assets. So let us start with the fifth one, bank deposits. For example, Murali wants to deposit 5 lakh rupees with the State Bank of India. Commercial banks offer 2 types of deposits, demand deposits, term deposits, savings account and current account. These two come under demand deposits. Fixed deposit and recurring deposit. These two come under term deposits. Assume that Murali wants to open fixed deposit account with this 5 lakh rupees. He wants to deposit this amount for 1 year period and bank is going to give 6.5% interest to Murali. So 5 lakh into 6.5%, 32,500 is the interest which is to be paid by banker to deposit holder for 1 year period. At the time of maturity of this account, bank has to pay 5 lakh rupees plus 32,500. 5 lakh 32,500 rupees to Murali. Murali is going to keep this 5 lakh rupees with the banker for 1 year period, no? So during this 1 year period, bank may use this amount for investment purpose or bank may lend that money to needy people. So on that, bank earns some income. From that income, bank pays some interest to deposit holder. Don't think that Murali has to keep this amount compulsory for 1 year. In case of emergency, Murali can go for premature withdrawal. Means before 1 year also Murali can withdraw his money by closing his FD account. But he will not get this much of interest. And bank may charge some financial penalties also. Here Murali is considered as an investor because he is depositing the money with the banker by expecting some interest. And he is also treated as lender because he is giving loan to banker. So bank is treated as borrower. So between this borrower and lender, there is one contract. As per that contract, lender is lending the money for a particular period. So as a written proof, lender expects some acknowledgement from this banker. That acknowledgement is known as fixed deposit receipt. FDR looks like this. It contains deposit holder's name, deposit amount in words, tenure, interest rate, bank's signature and maturity date. At the time of maturity date, how much money is going to be paid by the banker, that amount. This FDR comes under financial asset because it is a written proof for the contract between borrower and lender. So this is about fifth point, bank deposit. Next point is accounts receivable. For example, Ram and Co, a seller, sold 1 lakh worth goods to Raghu on credit. Sales are of 2 types now, cash sale and credit sale. Cash sale means what? Seller gives goods to buyer and immediately buyer pays money to seller. Credit sale means payment will be postponed. Seller gives goods to buyer but buyer requests some credit period. Assume Raghu asked 1 month credit period to Ram and Ram accepted Raghu's request. So this is known as credit sale. Here who is giving loan? Ram and company. Who is taking loan? Raghu in the form of 1 lakh worth goods. Who should give written proof to who? Raghu has to give written proof to Ram and Co. Suppose Raghu prepared a promissory note. This promissory note contains the details of this contract and it is considered as a financial asset. In Ram and Co books, Raghu appears as a debtor, accounts receivable. So it will be shown under asset side of balance sheet. Suppose Raghu made a default, means instead of paying the money after 1 month, he took extra 10 days time. So for that 10 days period, firm takes interest from Raghu. So here financial asset is promissory note because it is acting as a written proof for the contract between borrower and lender. Promissory note is prepared by borrower. Suppose lender is preparing one written proof, then it is known as bills of exchange. So lender draws that bills of exchange, he takes the acceptance of borrower, and that bills of exchange acts as a written proof for this contract. Even bills of exchange also comes under financial asset. Bills of exchange is also known as commercial bill. From lender's point of view, this bills of exchange is known as bills receivable, because on that particular bill in future lender is going to receive money. So bills receivable is an asset. From borrower's point of view, same bill acts as a bills payable, because in future borrower is going to pay the money on that particular bill. So to borrower, that bills payable is considered as a liability. So in case of accounts receivables, that written proof may be promissory note or bills of exchange. So these two come under financial assets. So this is about sixth point, accounts receivables. Next, insurance contracts. To explain this point, I am taking endowment policy of life insurance contract. Assume there is one nuclear family, husband, say Ravi, his wife, son and daughter. Ravi is sole earning member of this family. If he meets a premature death, his family becomes financially helpless. So Ravi wants to give financial security to his family. Then Ravi is supposed to insure his life. So he has to take life insurance policy on his life with one insurance company. In India, in government sector, we have LIC, Life Insurance Corporation of India, which is offering life insurance policies. In private sector also, we have so many companies which offer life insurance policies. Let us see some popular Indian insurance companies which are offering life insurance policies. Max Life Insurance Company Limited, Kotak Mahindra Life Insurance Company Limited, ICICI Prudential, Aditya Birla Sun Life, Tata AIA, Bajaj Alliance, Reliance Nippon, Aviva, HDFC Life Insurance, SBI Life Insurance Company Limited. Say Ravi wants to take the policy with the LIC. Ravi has to take life insurance policy with a certain amount. Suppose with 10 lakh rupees he wants to take policy. He has to take the policy for a certain period. Life insurance contracts are long-term contracts. So people take policies for 10 years period, 15 years, 20 years, 25 years and so on. In our example, assume Ravi wants to take policy for 20 years period. So to enter into contract and to continue this life insurance contract, Ravi has to pay some consideration to insurance company, which is known as premium. Premium will be decided by the company based on some factors such as type of the policy which Ravi is going to take, his age, his health condition, etc. Say Life Insurance Corporation fixed 30,000 rupees premium per annum. So Ravi can pay this 30,000 as a lump sum amount or on installment basis, monthly, quarterly or half yearly he can pay this premium to company. Assume Ravi met with a premature death. He paid first 3 years premiums and in 4th year he met with one accident, he died. Then in 4th year policy gets matured and policy value, that is 10 lakh rupees will be given to Ravi's nominees. So how much premium Ravi paid to company? 3 years he was alive. So 3 years into 30,000 rupees per year, 90,000 rupees. But at the time of death, when policy matures, company is going to pay full amount, policy value to nominees. For that sake only people take life insurance policies. Suppose Ravi is alive for this 20 years. So how much premiums he paid to company? 20 years into 30,000 rupees premium per year is equal 6 lakh rupees. When 20 years complete, policy matures and policy amount 10 lakh rupees will be paid to Ravi. So how much is the profit to Ravi? 10 lakh rupees minus 6 lakh rupees, 4 lakh rupees. Because instead of taking life insurance policy, if Ravi deposits this 6 lakh rupees in any bank or if he invests that money in share market, then on that amount he will get some income, no? Here also Ravi gets some income from insurance company. Here Ravi is a lender because he investing money with the company and Life Insurance Corporation of India, insurance company, is a borrower because they are taking money from Ravi. Who needs a written proof? Investor needs a written proof. Who has to issue that proof? Company. So, as a written proof, company issues one insurance policy to policy holder. This insurance policy is treated as financial asset because this is also a written proof, acknowledgement for the contract between insurance company and the policy holder. So in this contract you can see two parties now. So the company which is issuing this policy is known as insurer, and the person to whom this policy is issued is known as insured. So insurance is a contract between insurer and insured, where one party, insurer, is accepting to pay the claim amount at the time of any mishap. Mishap means it may be an accident or it may be some death. In case of fire insurance policy, marine insurance policy, mishap is fire accident or sinkage of ship, damage of goods which are in transport, etc. In case of life insurance, mishap is premature death. So if any premature death happens, insurance company is accepting to pay the claim amount, policy amount to nominees of insured. A written proof is issued by insurance company. That written proof, that policy document is considered as a financial asset. So this is all about 7th point, insurance contracts. Let us see the 8th point, pension fund. Pension fund is also known as retirement fund. Private employees who wants to have a steady income after their retirement age prefer to invest in pension funds. Suppose there is one private employee whose age is 35 years. In 2020, he decided to invest some amount in pension fund. Then he has to choose one designated pension plan. In India, pension plans contain two stages. First one, accumulation stage. Second one, vesting stage. In accumulation stage, investor has to invest money. Suppose employee's retirement age is 58 years. So, from 2020 to 2043, these years are known as active working years. During these years, he has to invest a small amount from his salary. Once he attains retirement age, he gets annuities from these pension plans. Up to the death, he can get the annuities. In some pension plans, instead of paying annuities, at the time of retirement, a lump sum amount will be paid to employee. If he dies before that retirement age, at that time, that lump sum amount will be paid to his nominees. Thus, some pension plans contains risk coverage facility also. In India, pension plans are divided into three types. First one, pension plans sponsored by insurance companies. If employee invests in this type of pension plans, his money will be invested in debt funds, means in debentures and corporate bonds. Comparing to equities, debt funds are safe. So, this type of investment plans are suitable for the conservative employees and the low risk employees. Next one, unit linked plans. These are most popular pension plans in our country. Here, investors' money will be deposited in debt funds and equities. Debt funds offer low risk facility. Equities offer high risk facility. So this plan is a combination of these two. This plan is suitable for the investors who are ready to take moderate risk. Moderate risk means risk will not be too low or too high. Thus, this investment plan gives a balanced portfolio advantage to employee. Then third one is National Pension Scheme. These pension schemes are sponsored by government. Here, employees' money will be invested in government securities or debt securities. Thus, these plans are also suitable for the investors who don't want to take much risk. So, in all these pension plans, when investor enters into the contract, a written document will be issued to him. So that the written document, that the pension plan document is considered as one financial asset. So this is all about 8th point, pension fund. Let us move to 9th one, mutual fund. For capital requirements, public limited companies issue shares and debentures. Suppose Kiran is one investor, he is interested in stock market. He wants to invest 5,000 rupees in share market. But the problem is Kiran doesn't know anything about share market. Even though he knows, he has a little amount. So with the 5,000 rupees, he cannot go for a diversified investment option. Means he cannot invest this amount in shares of many companies. So he can invest that amount hardly in